Hi there, folks. Charlie Gipple, certified financial planner here. Hey, I work with some of the finest financial professionals across the country, and it's possible that one of those financial professionals sent you this video on what I believe to be one of the foremost risks that consumers face in retirement. And that risk is the risk of needing long-term care. The risk of not being able to take care of oneself and having to hire somebody to take care of you. Not only is this a very prominent risk, as in a 7 in 10 chance if you're over the age of 65, you're going to have this, it's also a very expensive risk. And by expensive, what am I talking about here? I'm talking about $10,000 a month is currently, around $10,000 per month is currently the median cost of a private room in a nursing home across the country today. Hundreds and hundreds of thousands of dollars this risk, long-term care, could cost you. But if you got this video from a financial professional, make sure you ask them about some of the solutions that we're going to talk about here in a bit, if any of these float your boat. So how do you pay for long-term care? One way is out of pocket. Most people don't want to do that. Another way is Medicaid, which means you have to spend all of your assets down to where Medicaid says, yeah, you've basically impoverished yourself, we'll pay for it. But the third way, which is what I want to talk about here today, is long-term care insurance. And I simplified the long-term care insurance world into 3 different areas. Number 1 on the bottom left is the great granddaddy of them all, traditional long-term care insurance. This works like health insurance, right? You pay a premium every month or every year, and if you go on claim, the insurance company will pay out to that care provider or whoever it is that took care of you. It has to be a licensed care practitioner, right? They will pay out whatever the benefit is on that long-term care policy, or whatever it was that the long-term care services cost. But here are the 2 criticisms with traditional long-term care. One is man, but like with health insurance, if I don't use it, I lose it, right? If I just pass away 20 years from now and I've paid this premium of whatever, $5,000 per year, I don't get anything. I don't have any beneficiaries that get any value out of that, right? If I don't use it, I lose it. Yes, that's one criticism with traditional long-term care. The second criticism is premium increases. Over the last couple of decades, those policies issued, a couple of decades ago, have had premium increases substantially. Why is that? Well, without going into details, it's because the policies as of 20 years ago or so were priced too conservatively, or I should say too aggressively cheap for what the insurance companies should have done. The insurance companies learned a couple of hard lessons, and as a result, folks had gotten big premium increases. But regardless, those are the 2 issues with traditional long-term care insurance. Well, the good news is, and I like traditional long-term care insurance, but I also like these other 2 categories as well. And these are kind of the new kids on the block relative to the left block over here. These are the new kids on the block. That is the middle block here, combination life/long-term care. So once upon a time, an insurance company somewhere said, hey, life insurance, it kind of sucks to have somebody needing to pass away in order for somebody to get that $500,000 death benefit. For somebody to having to go and die in order for somebody to get that $500,000, that's no fun. Is there a way to where we can innovate? Is there a way to where we can pay out that $500,000 in the case of, say, somebody needs long-term care? In the case of, say, somebody cannot do 2 activities of daily living for a 90-day period of time. And we'll talk about activities of daily living in a bit. And the product development folks said, that's a great idea. Yes, so let's make the death benefit available for purposes of long-term care. What I just explained is a combination life insurance/long-term care policy. But then you have the box on the far right, which is the combination annuity/long-term care. This is, let's say you have $100,000 sitting around or in a checking account or in a savings account. Wouldn't it be cool if you can move that $100,000 into a long-term care annuity and instantaneously turn that $100,000 into $300,000 from a long-term care benefit standpoint? Wouldn't that be cool? That's exactly what the combination annuity/long-term care hybrid product does that I'm about to talk about. Now, the box in the middle and the box on the right is now around 80% of the entire long-term care insurance industry's product sales today. Around 80% of the industry is the middle box as well as the right box. Why is that? Because consumers, they oftentimes do not like the use it or lose it proposition of the traditional long-term care. And a lot of consumers have heard about the premium hikes that have happened with traditional long-term care. And by the way, folks, I like traditional long-term care because it will give you the most long-term care benefit per dollar that you pay in premium of any of these. But you have those two concerns that many consumers have. So let's use an example number one, which is traditional long-term care, and then we'll contrast this to the other two, the life insurance policy as well as the annuity. So here you have male age 60. This male age 60 says, yeah, I get that it's $10,000 per month or so that a private room in a nursing home may cost me ultimately, but I just want to insure half of that. I'll have Social Security coming in. I'll also have some retirement income coming in. I'm fine with just insuring half of that risk here. So he wants a $5,000 a month benefit. First of all, what's the trigger? Like with health insurance, you pay health insurance. When does a benefit get triggered? Well, when you go to the doctor or the clinic certifies that you've had care taken care of, and then the insurance company pays that clinic, right? Well, what's the trigger for long-term care? They are almost always the same. They are always the same as far as I know on all of these long-term care policies. And it's two different triggers. One is that if you are unable to perform two activities of daily living that's expected to last for a 90-day period of time, then that's when the insurance company will approve paying out this, say, $5,000 per month. Now, what are activities of daily living? There are 6 of them. There are 6 primary activities of daily living that the insurance carriers look at. One is bathing, one is toileting, one is dressing, one is feeding oneself, continence, as in maintaining your bladder, maintaining your bowels, and the other one is moving around. I think some call it ambulating. Those are the 6 activities of daily living. Dressing yourself, feeding yourself, dressing, eating, bathing, toileting, continence, and moving around. If you cannot do 2 of those 6, then you're going to go on claim, and if it's expected to be a 90-day period of time. The second trigger is severe cognitive impairment. So think dementia, for instance. That is a trigger with all of these policies as well, at least that I know of. And I know of almost all these policies. All right, so what's a benefit period? So you're going to get $5,000 a month, but for how long? Well, that depends on what type of benefit you and your financial professional chose. In this case, I chose a 48-month benefit, which is probably a little conservative. Claims are getting to be longer duration. With dementia, it could sometimes be 6, 7, 8, 10 years that one is on care. But I chose 48 months in this example. So 48 months times $5,000 a month, that is a total long-term care benefit pool, as I call it, of $240,000. But it's not just $5,000 from here off into perpetuity until whenever it is that our hypothetical client goes on claim. It will be more than $5,000 a month, right? Why? Because on this particular policy, I added a 3% inflation rider. What that does is it says, yeah, your maximum monthly benefit if you go on claim in this year is $5,000, but $5,000 today isn't going to buy much 20 years from now. So that's where you might want to attach an inflation benefit. You almost always want to attach an inflation benefit because, well, we have inflation, especially nursing homes, especially anything healthcare related has inflation. I would argue it may even be better to look at the 5% inflation option. So what you have here is not only is that monthly benefit increasing because we put on the inflation rider, but also the total policy limit, the total long-term care pool, as I call it, is increasing as well. So that's what we put on this product. And yes, folks, we're getting to the premium here in a bit. You're probably already wondering, how much is this going to cost? We'll get there. Benefit settings. Folks, this is not nursing home insurance. Why do I say that? It'll cover the nursing home, but why do I say that? Because I've gotten this before. Oh, that's that nursing home insurance. I don't want to go to the nursing home. This can also be stay out of the nursing home insurance as well, as a matter of fact, when I worked at Genworth, the largest long-term care provider at the time, by far, 76% of the claims started out not in a nursing home, but in the folks' own home. When I want care being given to me, I'm more comfortable in my home. These long-term care policies are not just nursing home insurance. It's also in your own home insurance. So those are the benefit settings that this particular policy will pay for. What about the death benefit? Well, as we just talked about, this is traditional long-term care. It is a use it or lose it proposition. There is zero death benefit. If you paid premiums for 20 years and just passed away, nobody gets any benefit out of this policy. Although it's likely a 7 in 10 probability you're going to go on claim, right? Which is the reason we need some sort of insurance for this very prominent and very large risk. For this particular client, $3,119 per year, which is very, very cheap, I would argue. What are you buying? Well, if you look out 15 years out when this client is 75 years of age, a $363,000 benefit pool for $3,000 per year that this person paid. And if you had a financial calculator and said, okay, so if he went on claim at that point in time and sucked down all of his $363,000, what type of return would that be? Tax-free return on his $3,100. Folks, it would be significant. Actually, as soon as I stop this video, I'm going to see what that internal rate of return on his investment will be. Again, 100% tax-free. But again, two different concerns that folks have over the product that I just showed you. Number one, use it or lose it. Number two is, can that $3,100 increase? It is possible, yes. So that's where you get into that middle box here, right? So we're going to the right, that middle box, which was life insurance / long-term care. That is this example here. So here we have a couple, a 60-year-old couple, and both of them, kind of a similar deal except the couple. Both of them say, you know what? Each of us would like $5,000 per month. The other person is going to have income coming in to where, you know, he or she can offset the whatever the nursing home costs above $5,000. You know, the person that's in the nursing home or in home care is going to have their Social Security coming in. Yeah, we only want to look at, say, $5,000 a month. Now, I am a fan of insuring the entire risk myself, but it doesn't always have to be that. But in this example, let's just say $5,000 a month benefit, like what I just showed you, except this benefit is available to either him or her, or both of them at the same time, which would be $10,000 a month. $5,000 her, $5,000 him. Okay, so what are the long-term care benefit triggers? The same that we just talked about. 2 activities of daily living or severe cognitive impairment. What benefit period did I choose here? There are various benefit periods. Just by example, I chose the 66-month benefit period. They did not have a perfect 48-month to make it apples to apples, but I chose 66 months. So that is 66 months times $5,000 a month. That's a third of $1,000,000, right? That's $333,000. That is the total long-term care pool that one is going to be paying for with the premium that I'm about to get to here. Did I choose inflation on this? No, I wanted to keep the math simple because I want to show you a diagram here that's simplified by not choosing the inflation benefit option here. What are the benefit settings? The same thing. So the same thing here. So same benefit settings, same long-term care trigger. But what is a big difference between this and the first one that I showed you? Here's the difference is, remember folks, at its core, this is a life insurance policy. So in this example, if both of them passed away without ever taking $1 in benefits from a long-term care standpoint, what goes to the beneficiary? $166,000. So this is not a use it or lose it proposition. This is also a life insurance product. This is a life insurance product at its core. Now, how much does the premium on this life insurance product cost? More expensive than what I just showed you, $6,095, but 2 very important points. One point is of course, there's a death benefit. $166,000. So yeah, naturally it's going to be more expensive. The second point is that $6,095, it's guaranteed forever. It cannot change. Guaranteed premiums, guaranteed benefits. Oh, and let me throw in a third point. The third point is whether he goes on claim or she goes on claim, or both of them at the same time, there is a long-term care benefit that is paid. The odds of one person of a couple going on claim is greater than just one person of one person going on claim, if that makes sense. One of a couple has a 91% probability, or there's a 91% probability that one person of two is going to go on claim versus the 7 in 10 probability that's just one person, if that makes sense. So let me explain this, what we just did, a little differently. So for $6,095, you're buying a life insurance policy that has a $166,000 death benefit. And again, once upon a time, a company said, wouldn't it be cool if we can give out that entire death benefit, $166,000, not by dying. Yes, if they do die, then the beneficiary is going to get that $166,000. But wouldn't it also be cool if they go on claim from a long-term care standpoint? And One America specifically said, yeah, so that's what we're going to do here. That entire death benefit is available for long-term care. But then One America took it a step further, as well as a couple other companies, took it a step further and said, but wouldn't it be cool if, say, both the husband and wife in this example are on claim? So that's $10,000 a month. Say 17 months in, when this value here hits zero, because 10 months or 17 months times 10 grand, yeah, you've sucked away all the death benefit here. Wouldn't it be cool if we could then give another $166,000 for purposes of long-term care? So what is called a continuation of benefits for long-term care. And the company said, yeah, let's create that product. So what you have here is a life insurance product that not only gives the death benefit for purposes of long-term care, but this one actually gives double the death benefit for purposes of long-term care. Actually will give more than double the death benefit. You know, you could actually choose a lifetime continuation of benefits rider on this particular product. Now it's more expensive, but a lifetime benefit says you can be in the nursing home, both you and him can be in the nursing home for a 30-year period of time, and we will pay that benefit forever. It doesn't stop at, say, $333,000. But folks, that's the difference here between this one and traditional long-term care. A death benefit product, but that death benefit, multiples of the death benefit, is available for long-term care purposes. Here is one of the favorites time and time again on these videos that I do, and it's this. What if a consumer has a portfolio that looks like this? You have annuities, you have stocks, bonds, mutual funds, real estate. Here are the amounts. Let's say that $200,000 at the top, the $50,000, $150,000, it's kind of lazy money there, right? So $200,000, it's kind of lazy money. It's earning, say, 3% or something, which is pretty low in today's environment, today being May of 2024. Wouldn't it be cool if you could have that money work harder for you? As in, that $200,000, here's what we're going to do. We're basically going to take the long-term care thing and just get it done with one fell swoop. Not the ongoing premiums that we just talked about, but just one chunk of money, that $200,000. So $200,000, here's what we're going to do. We're now talking that far box on the right that I showed you earlier, right? The hybrid long-term care annuity. So what happens when you move $200,000 into this hybrid long-term care annuity? Hybrid as in long-term care and annuity. That's why we call it hybrid. Well, first and foremost, you might get an interest rate that's even higher. So a 5% interest rate is what is currently on this one example product. Now, technically, it'll be a little less than 5% that your $200,000 is going to grow by, because there are some long-term care expenses that will go against that accumulation value in there. But let's call it 3%. So your $200,000 is going to grow by a net 3%. Not bad, right? Well, what happens if I pass away? What does my beneficiary get? Whatever that $200,000 has grown to. 100% penalty-free death benefit goes on to the beneficiary. Okay, well, what happens if maybe 5 years from now I change my mind and just want to cash it out? Yes, you can do that. Whatever it's grown to, you can cash it out. Now, technically, this product has a 9-year surrender charge schedule. So if you cash it out prior to 9 years, just know there will be a surrender charge, like a lot of other annuities. Heck, like many certificates of deposit, where you lose a good chunk of your interest if you cash it out early. But it's the same logic as any other annuity. But that's beside the point to the bigger picture here. The bigger picture is this. is immediately, with very little underwriting, your $200,000 goes to $600,000. It triples on day one. Now, you can't just take out $600,000 just in one fell swoop and say, yep, I can't do 2 activities of daily living. I want my $600,000. You can't do that. There are benefit periods like what I just showed you, and the benefit period on this one is 72 months. So what does that mean? It means if you divide 72 into $600,000, that means that your maximum monthly benefit is $8,333 per month. And if you max that out every month, again, how long does that go? Folks, it goes for 6 years, for 72 months. This is a great way. There's a barrier to entry though, right? You have to have chunks of money. Not everybody has $100,000, $200,000, $50,000 laying around. So that's a barrier to entry. But for the folks that just want to get it done with one fell swoop, this oftentimes can be the key. So those are the 3 types of long-term care solution products. Folks, if you have any questions on this, ask the financial professional that sent you this video, well, what your questions are on any of these 3. Also remember to like this video and subscribe to my channel. Have a good day.